Hi everyone, welcome to Excel Clinic. In this episode, we will be talking about time value of money, specifically discounting and present value. Present value is a very common term used by accountants, especially in recent years following the pronouncement of IFRS 16 leases. Give you a few examples. The term is used in IFRS 16 when it talks about the initial measurement of lease liability. IFRS 9, the requirement that financial instruments that carry no interest should be recognized at present value. Most importantly, the IFRS 13, which defines fair value measurement for the entire IFRS, allows present value technique for level 3 fair value measurement. Present value may be overwhelming for some people, so follow me no OT. Let's revisit the basic concepts before we teach our assistant, Mr. or Miss Excel, to do the computation. It may not be the perfect textbook answer, but this is how I learned about time value of money. Assuming that you have 1,000 Singapore dollars. I specifically mentioned the currency here because I will be going through the prorations of interest later, and different currencies may have different day count conventions. But the general concept of time value of money is the same. You bring that $1,000 to a bank, and for simplicity, you deposited it into a fixed deposit account. Assuming that the bank pays 3.65% per annum, credited monthly, you woke up the next morning, check the bank statement, and you find, well, okay, all right, you may not see the interest being credited yet because it pays monthly. We have to understand that in most cases, the interest is not credited into the account on a daily basis. The frequency of interest payment affects the total interest you receive over the deposit tenor. Really? Today is 1st March. You have 1,000 in your bank account. At the end of the month, the bank computes the interest based on that $1,000, applying the 3.65% per annum interest and prorate based on the number of days in March over 365 days. That is $3.10 for 31 days. Well, not bad. USD denominated instruments usually use the 30-360 day count convention, so the prorate of interest will be slightly different. The following day, you woke up in the morning and you check the bank account. It shows you that you have $1,003.10. On 30th April, thinking that you will get another $3 of interest, the bank surprises you. It gives you that additional 1 cent because it computes the interest based on the revised principal amount. This is what we call the compounding effect. 12 months later, you create a table, summarize the interest you receive, and you notice that you collected $37.12. If you were to apply 3.65% per annum to 1,000, without considering the compounding effect, you will only get $36.50 worth of interest. So you divide that $37.12 by 1,000 and you realize that it is 3.712% per annum. I bet no one will call the bank and find out why, but you might if you don't already know about this and it is a loan from the bank instead. It works the same way. 3.712% is the annual effective interest. 3.65% is what we call the nominal interest rate. So even though it is quoted on a per annum basis, you need to know the interest period or compounding frequency. Interests are not always paid monthly. It could be quarterly, biannual, or annual payments. Why I talk about this is because I've seen many accountants use the nominal interest rate to discount annual cash flows without considering the compounding effects. So do take note of the interest period or compounding frequency next time. The present value at the inception of the fixed deposit is 1,000, and the future value at the maturity is $1,037.12. To convert from present value to future value, you can multiply by 1 plus the interest rate to the power of n. N is the number of periods. To convert the future value to present value, you need to do division. So let's consider a slightly more complicated scenario, an installment plan. What we discussed earlier is a single cash flow instrument. An installment plan has multiple cash flows happening at different timings. So you have to discount them separately because the timing of each cash flow is different. There is a shortcut and I will share it later. The installment plan lasts 24 months. Each month we pay $500. The interest is 1% per month. I'm ignoring the day count convention here. The first payment is due on the inception. One FYI, it is common in some installment plans that the interest rate quoted is not the annual effective interest rate and also not the nominal interest rate, but the simple interest rate. Simple interest rate is really simple. This is the formula. The total amount you will pay over the periods, or the future value, is just the product of the loan amount, number of periods, and the simple interest rate. But because of this computation method, its equivalent effective interest rate is higher than the simple interest rate usually. I believe there are good reasons why they present interest rate in this manner. However, it does seems a little misleading to me because it usually gives a much lower percentage than its equivalent effective interest rate. This gives an impression that the interest rate is low, especially if you are doing a buy or list assessment. Please remember to compare apple to apple. Bring the earlier scenario to Excel. Let's teach our assistant to do some computation. The interest is 1% per month. Can you use annual interest rate here? You could, but it will make the calculation later on more complicated. So I usually change it to match the interest period. Set up the table, month, monthly installment, and we want to calculate the present value of this installment plan. Apply the formula that we talked about earlier, and you should get what you want. But one thing to take note, the timing of the first payment is crucial. It determines whether or not you need to discount the first installment. If you will be paying the first installment immediately upon inception, then you don't discount the first installment. It is usually the case for higher purchase, so please review your contract. The formula is equal monthly installment divide 1 plus interest to the power of month count minus 1. Okay, if the first installment needs to be discounted, then no minus 1. Remember to make the reference to interest rate absolute and apply the formula to the rest of the rows. Do a sum and you will get 10,727 and 91 cents. Is there a shortcut? Yes. If each installment is the same, you can use the function PV. Equal PV, the first argument is the interest rate per period. The second argument is the number of periods. Third argument is the installment amount. The fourth argument, you can leave it blank unless you have a lump sum payment at the end of the installment plan. The fifth argument, you can ignore it if your first installment is due on the last day of the first period, i.e. you need it to be discounted. Otherwise, if the first installment is due at inception, it will be 1. Do note that PV function returns present value in the opposite directions of the installment amount to indicate that the cash flow is in different direction. Alternatively, or if you have inconsistent installment, you can use the function NPV. Equal NPV. The first argument is the interest rate per period. The second argument is the installments. If your first installment is due at inception, you will notice that there is a difference. The NPV functions assume that the cash flows happen at the end of each period. In other words, the first installment is not at the inception. So if your first installment is at the inception, you need to tweak the function slightly. There are two workarounds. Pick one that is more intuitive to you. Workaround number 1. MPV function in a way over discount the cash flows by one period in this context. What you need is to undo the over discounting by one period. You just need to multiply the MPV by 1 plus interest rate for a period. Workaround number 2. Ignore the first installment, get the MPV for the next 23 periods. Then add the first installment at inception manually without discount. Again, both methods work. Pick one that is more intuitive to you. Even though there is a single function, PV or MPV, that returns the present value, many accountants still prefer building such a cash flows table and doing the discounting for each cash flow. It provides comfort, especially to those accountants who are not very familiar with discounting. One last thing before we end the episode. For an installment plan that lasts more than 12 months, you may need to segregate between current and non-current portions for balance sheet presentation. How would you do it? Take 12 times 500, you get 6,000 as current portion and the remainder as non-current. By doing so, we are allocating the discounts for the first 12 months to the non-current portion. So personally, I don't think that is the correct way of doing segregation. In a more technical term, by doing so, the current portion is not at amortized cost. Using this table, what we should do is to sum the present value of those payments within the next 12 months. That is the current portion, and the remainder is the non-current portion. We can use some ifs. In column B, we indicate less than or equal to 12 for current and more than 12 for non-current. Equals some ifs. First argument is present values. Make it absolute. The second argument is the month numbers, and again make it absolute. Then the third argument is the criteria. Cell B33. Copy the formula to non-current. Do a sum and check. In the next episode, I will apply what we talk about in this episode to the lease accounting for lessee under IFRS 16 or Singapore FRS 116. We will build the lease schedule and right-of use asset schedule next week. Stay tuned. Don't forget to subscribe to this channel, share this video with your fellow Excel users, and say no to OT. See ya next Tuesday.